replaced. You can expect interest rates to stay pretty low for some time. The Federal Reserve anticipates leaving rates near zero until at least 2023. The major change the Fed is going through is one of the topics First Financial's Kirk Copenhaver talks about with Courier publisher Jamie Smith.
Thank you, Kyla. And Kirk, thanks for being with us today.
Yeah, thanks for having me on.
Absolutely. Can you tell us what's new in the market?
Last time we were on, we mentioned that the Fab Five, Apple, Microsoft, Facebook, Amazon, and Google, were becoming a risk to the market as they accounted for about a quarter of the S&P 500. Individually, those stocks were up 20, 40, even 80% apiece. This strength really pushed the market up 11% through early September, through September 2nd. But if you took those 5 stocks out, the market really would have been about flat. The past couple of weeks, though, the Fab Five, they've all corrected a little bit, and that performance gap has actually closed some. So whether or not this trend continues will be something to watch as 2020 winds down.
Okay. In your recent commentary, you talked about how the Federal Reserve is in the midst of a fairly major change. Can you talk a little bit about that?
Yeah, for sure. So, since the late 1970s, the Fed has really had a dual mandate of full employment and price stability. Because of this, the relationship between unemployment and inflation became super important for the Fed's decision-making. And something called the Phillips curve became a critical input in that decision-making process. Now, according to the Phillips curve, low unemployment indicates less slack in the labor market, which leads to higher wages and higher inflation. On the flip side, you get higher employment. That means more slack in the labor market, and that's less competition for available workers. That'll lead to less pressure on wages and inflation. Now, remember, prior to COVID, unemployment had been falling for years while the inflation really stayed low. And that basically signaled a breakdown in the Phillips curve. So in late August, Fed Chair Jerome Powell changed the Fed's employment goal from full employment to maximum employment. Now, while this may not sound like a big change, this means that the Fed won't look to unemployment rate as a signal for when to raise benchmark interest rates anymore. The Fed also said they'll now focus on an average inflation rate. So since inflation has been running below 2% per year for a while now, in order for that average inflation rate to get above that standard 2% target, it'll have to run hotter than that for quite some time. So what this means for us is that we're getting positioned for what we're calling a reflation reset.
Okay. I know now you're going to tell us what's a reflation reset.
Well, to us, there's several factors out there that we believe have set us up for a period of rising inflation. You've got booming twin deficits, both on the budget and the trade, and then for the United States, and also a weaker U.S. dollar. Money growth has been explosive. Trade tariffs and deglobalization, that could both lead to higher input costs. And then you've got this Fed shift to an average inflation target instead of kind of a set number. So you combine all these factors with the potential for rising global GDP growth, we think we see a setup where inflation beneficiaries should do well. As a result, we've kind of begun to increase allocations to international markets, which should benefit from that weaker dollar, increased our allocation of real assets like commodities that benefit from higher inflation, and also cyclical commodity-oriented sectors like industrials, energy, and basic materials.
Great. But now more than ever, we need you guys keeping us informed of not only the market, but just all the conditions out there. We thank you for coming on, and we hope to see you again in a week or so.
Well, thank you very much.
Thanks so much.